further or to reinforce some things. But what I wanted to point out was that if you went there, I am imploring you, pleading with you to write your feelings down, because what happens is you enter that fog. You know, when you get excited, you're fired up, you're so focused, but then you get home and reality hits, and you're trying to remember what was said and why you felt the way you did. And your notes will be the things that bring you back to remembrance. So write, while it's still somewhat fresh, write down how you felt and those things that were most important to you. And I can just really make a case that this next 90-day cycle, we have what's called a 90-day madman cycle. And that doesn't mean you run around like a madman. It means that you go out and work like a madman. But it's very important, because between 90 days from now, we'll be right at going into the Top Gun, and it'll be here just like that before you know it. So this is a very important time. And so we're going to provide you every Wednesday with this tremendous practical knowledge of the things on response for what's going on in today's world. And I will tell you, just to kind of let you know what you can look forward to next week, and some of the things that are coming up, is that next week we're going to talk about some of the uses of an IUL in terms of being a Swiss Army knife. You know, we've talked about be your own bank, which everyone knows about. We're also going to talk about what we call velocity banking. And what that is that if you use the IUL properly, you can even use it as a tool to pay down your mortgage, if that's something that's important to you. So we're going to give you concepts. And this always teaches concepts, because it's words and stories that are going to get us where we want to go. And it's going to be exciting. So we got great things happening. So Kimberly, anything else that you want to add as we get started?
No, I'm just super excited. I'm excited about this concept, this conversation. I think it's something that is obviously, you guys know, we're talking about infinity banking, bank on yourself, whole life, IUL, because all over the world, that's what people talk about right now, right? That's the buzzword, the hot topic. It's all over TikTok. And so I want you to understand the differences between them. So you can articulate it if you need to articulate it. If you don't worry about it. But I think the more we know, the better we do. I think that's what someone said at our Atlanta meeting, right? So anyway, let's get started with Tim. Tim, you want to give us a market update? Tell us what's happening in the world.
Yeah, it's been interesting just to see the rebound. You probably heard me talk about this. For those who were in the audience at the convention, I discussed the August 5th. The market kind of crumbled on August 5th around the world. A lot of catalysts to that, but it's interesting how we've completely rebounded. But look how long it took to rebound the market, and how it took only one day for that crash to happen. That shows you the volatility we're in. I don't really see much happening now until the election, other than we're going to see a lot of bouncing around, and the key word here is still going to be volatility, just because we're so many different convoluted cycles were being kind of, the perfect storm is being thrown in today. But I want everybody to kind of be aware of some things that are going on. And it's all centered around interest rates. So as you all know, we've had this long period of time and where interest rates were basically zero. And it's hard to even describe what that does. Number one, let's talk about the currency. So the dollar, the US dollar, what does that do to the dollar? Obviously, it strengthens the dollar. It makes the dollar a very strong currency. So what does that mean? That means that we have more buying power. We as Americans have more buying power, buying goods and services abroad, buying goods and services here in the US. For those living abroad, it weakens their buying power. So imports, so people buying our exports, it makes it more difficult. So when you think about the impact of a strong dollar versus a weak dollar, you think about the impact on the economy. And also, the 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 Federal Reserve now is everybody is pricing in. I mean, not everybody, but the the powers that be on Wall Street are pricing in a 25 basis point decrease here in September. Pretty much given that they're going to drop 25 basis points. I got a kick out of this last go around on August 5th when the markets blew up and everybody was in arms. Oh my gosh, the Feds didn't, they didn't act quick enough. The sky is falling. It sounded like the Wizard of Oz, kind of situation. And and they were calling for an immediate reaction. So the Fed, it just it always cracks me up when you listen to these. And I'll be kind. I call them the talking heads on all these networks. This is it's so important to get people off of the watch. Don't watch CNN or CNBC or Fox Business or any of these networks because they're a lot of times it's just hype and too much news almost on all this stuff because it's over talked, it's over analyzed. And if you just have a general knowledge of what's going on, it's going to help you deal with people. And so the Federal Reserve has ran interest rates up, as you all know, to 5.25 to 5.50. That's kind of the target range right now. And they're going to drop at 25 basis points. That's been priced into the market. It's going to happen in September. The Fed meetings notes are coming out today at 2 p.m. So the market is basically dead right now, waiting on that. And as I said before, we're sitting on a strong dollar that is forecasted to become weaker and weaker. And a weak dollar is not bad, really. It's going to help. It's going to help our exports. So it's a balancing act when you look at an economy like the U.S. and also the currency. Obviously the U.S. dollar is the world currency still. So when you think about all the benefits out there, obviously the housing market is still strong. There's not enough inventory. When you have that long of a run of zero interest rates, I've got a 3.25% loan on a rental house I have. Most everybody, who refinance now has a 3% loan on their mortgage. I mean, why would you sell, right? I mean, we haven't seen those rates since the 1950s, since after World War II, when they had to get the economy going again and interest rates were really low. So we don't think we'll see those rates again. And in a normal rate environment, you're going to see 4 to 5 to 6%. So that's kind of the range we're in. But we could see a 100 basis point drop here over the next year. And that's kind of what the markets are gauging into what's going on. Recently, we saw a U.S. payroll decline of 0.5%, which has been the largest decrease since the revision has been tracked since 2009. Unemployment dropped to or raised to 4.3% recently. Politics are playing a big factor into the markets today. So there's a lot of unknowns. Who gets elected? Is it going to be the current administration with Kamala? Is it going to be Trump again? And there's different issues going on with Wall Street with either one of those candidates being the president. I don't think it really matters in the end. Nobody really cares. They're gonna drive different issues in Congress, but I think it's going to lock up the House and the Congress. So there's not going to be a lot of issues going to be dealt with, which is good for the economy, really, that you don't have both parties controlling Congress. So overall, Kimberly, I'll turn this back to you. I think we're just going to see the markets go sideways here for a while. We're going to see some volatility, possibly some up and down, some vibrations, and some hoot and hollering, and you're going to see a lot of politics until the election is over. I think the big dramatics will probably come in the first quarter of 2025 is what I expect to see. If anything happens at all, I still call for a market decline sometime in first or second quarter of next year. So turn it back to you, or if anybody has any questions, I'd be glad to address.
Hey, Tim, what about the tax, this massive tax increase that's on the horizon in January? I think that's something that we need to be talking to our clients about, because as we know, the Trump tax cuts are about to expire. And on the whole payroll news, they're about to revise the last 12 months by 1 million jobs, Tim, if you can imagine.
Yeah. Obviously, we talked about this before, Greg, and I think you were on the call, weren't you? Do you remember that?
No, I do not.
Oh,
That may have
okay.
been one. That may have been one I missed, Tim.
Yeah, they expire actually at the end of 2025. So that's something from a planning perspective that we're all going to be talking to our clients about at some point. And that's really plays into our life insurance planning side a lot more here going forward, because that opens up a lot more planning kind of conversations with families. It's going to lower the deduction for estate planning purposes. So this is something that we really don't expect Congress to do anything on this issue, and they're just going to let it sunset and expire. That's the easiest thing for them to do. And frankly, the government's got to raise more money anyway. I mean, we crossed $35 trillion in debt, which is another milestone, obviously, and we're heading into about 1.9 trillion deficit per year. So that number keeps getting bigger. At some point, the deficit here overall in our government is going to be the issue. We don't know when it's going to surface. And it's funny how the politicians just basically skate around it right now. But good point that you brought up, and it's something.
I remember, Jody, we're echoing with you, I think, a little bit, but I remember someone from the conference, I think maybe it was Corbridge, they said they're going to start doing the life insurance, trust conversations, and having those conversations about life insurance and trusts and things like that. So I think as tax cuts go away, right, and our estate exemptions reduce, that might be a relevant conversation, just a concept to understand and to learn going forward. But thank you, Tim, very much. I appreciate your market update as always, and it will definitely be very interesting to watch and see what happens, through the election and also early quarter of next year, to see where we are. And I think it's still the same story that we've been telling for a minute, is the flight to safety, whether we do that through IULs and indexed annuities, or we do that through active management with WFS. I think that's the story all the way around.
Yeah, it is about the flight to safety, and I think we all talked about that. Is that echoing me?
It's Jody. Just keep talking.
I can't.
Sorry.
You're unmuted on both devices. I think that's the problem. You got to mute on one.
Yeah, the flight to safety issue is really what we talked about at the convention. Is what we're in the protection business. I think I mentioned that in my little conversation with everybody at the convention, and then I brought up Chad at talking about the wealth format system and how we're going to bring this around more in full circle. We'll talk more about WFS in the future, but really the tools in our quiver right now, the arrows in our quiver, are really the Index Universal Life. Obviously, is a powerful tool for planning, for legacy, all these different issues of protecting families is so relevant today that most of middle America do not understand the ramifications of planning for their legacy, for their family, and having that safety net, basically protecting the downside, is such a powerful tool.
Yeah. Thank you so much. Jody, you want to say something? You want to introduce Alan, or you want me to, or?
I'd be glad to, but thank you, Jim. I find tremendous value every week in this information. It's awesome. I think we're the perfect blend of both sides of what you've got to have, which is the head and the heart. There are no gaps in what we do. You know, a lot of people go out and they place their hopes and dreams and things that look like businesses, and they get all the hype and they get excited, but there's really no business underpinning. And then there's other things that are so boring and business oriented, they don't aim at the heart. And here we get both sides. It makes me proud knowing that what we do for people is right, it's timely, and if they don't hear it from us, they're not going to get it anywhere else. So that's just great stuff. So thanks, Tim. But we're really blessed today to have Al Zuckerman on with us. Al's friend of the team, friend of all of us. He's a friend of HGI in a great way, but he's also, you know, a great part of a Nexus. He's the face of a Nexus when it comes to what we do. And he works closely with companies like Nationwide and North American and many others. But he's also here today to help us from an education point of view. Just talk about that conversation between, you know, the whole life insurance and IUL, Index Universal Life. And the reason that this comes up is because one is that there's been a little bit, you know, more of a spike in information out there on whole life and also where in general, but also where it relates to the concept of being your own bank. So we want to talk a little bit about that. And we love to hear from Al and anything he wants to tell us. So Al, thanks for being on. Appreciate you being here. Excited to hear from you.
Thanks, Jody, and great crowd. This is awesome. I'm really, I feel blessed to be able to be here. And Kim, thanks for inviting me. I always look for opportunities to talk with the team, and that this is great. So I was listening to Tim a little bit on the whole idea of the question that came up around the sunsetting that Greg asked, and then the idea of legacy planning. And that's really where this thing starts to have a lot of wheels and a lot of power behind it. And that's that whole idea of, and Kim, you mentioned the flight to safety. That's a big deal. But safety and legacy is not all defined as death benefit. Death benefit is great and it's important and we need that. And we all know that Americans, particularly middle America, does not have enough of it. But then the question has to be, where do you get the biggest bang for your buck in terms of doing that? And can we be a little bit more of a Swiss Army knife? When you're dealing with middle America that doesn't have endless dollars, they're not the ultra wealthy, the ultra high net worth kind of marketplace. How do you be more of that Swiss Army knife and get them multiple solutions potentially in one product? It doesn't ultimately, whether it's an IUL or it's annuity or it's whole life, they all work for different kinds of solutions. But the question becomes, with limited dollars available, how do you get the biggest bang? How do you get the most efficient use of those dollars? And that's where the discussion starts to separate itself. Or that's where you start to look at it and say, gee, could I do something more efficient and create and also have a legacy and also be a flight to safety? I was talking with actually an HGI advisor this morning, 6 o'clock this morning. And the question became a guy who happens to be high net worth, a pretty fair portfolio of real estate. And he's getting spooked because of the marketplace, because of market conditions right now. And he does a lot of what's called a 1031 exchange, tax-free transfer of real estate to other real estate. And that's all well and good, but now he's going to liquidate a good portion of his real estate because he thinks there's going to be a huge downturn in the market. Now, if that's true, and if that's the belief, then where do you go with those resources? Well, in that case, it may not be purely a a death benefit play, because that person was relying on real estate to create an income. So we have to look at a multifaceted approach to how we create that certainty, because it is about creating certainty for the client. Where do they get more certain, more probable results? And that might be in looking at tax-free income. That might be partly a death benefit. It may be the long-term care or living needs benefits that are out there. All of that plays in to an inclusive
type of story. So when you look at a life insurance policy, particularly IUL, and going to this discussion of be your own banker and whole life, you really start to get into a little bit different type of discussion. And that discussion really is about efficiency of the use of dollars. And when you look at whole life by definition, whole life was not really ever designed to create a stream of livable income. It was designed originally to give you back the money, and by pure definition, dividends are a return of excess premium. In other words, you paid too much in initially, and so we're going to give it back to you. But you paid in what the carrier told you you needed to pay. So dividends are not a guaranteed element of a whole life policy. And in order to understand what you are getting, you have to understand the history of dividends. Just like indexing, dividends can change. And if you go back in history, I actually have a visual. Let me share my screen. Do I have screen sharing capability, Kim? Let's see. No.
I will give it to you right now.
Awesome.
Now you do.
Okay. So let's. Oop. My system now is being slow. Hold on one second, guys. Sorry about that. Let's see. Are you seeing my screen now?
Not yet. It's
Yeah.
just spinning.
It's,
There we go.
it's coming up.
It's there now.
Okay. So what we have here, and this is a third party. This is not something I created. This is third party, but you see multiple carriers. It's not about the carrier necessarily. What it is about is this discussion of manufactured products versus live products. But you see historically, this goes back to 1995. If you bought a whole life policy in 1995, what were the dividends being paid in 1995? Coincidentally, about 80% of the rate of return in a whole life contract is generated from dividends. So you look at that far left side in 1995, what were the dividends paid out by these different companies? Fast forward to 2023 and look at where the dividends are today. Now, in a traditional illustration, you don't change dividend rates, just like we don't change illustrated rates in an IUL. You use the same illustrated rate all years. Now, we have the capability of changing illustrated, but most don't do that. When you look at the difference between a policy you would have bought in 1995 that uses static dividend rates, but now dividend rates are 30 to 50% less depending on the carrier than they were, how could what, and that represents 80% of the return in a whole life policy. How can the illustration that was done initially be even remotely accurate? Because that's 80% of your returns. So this idea that because it's whole life, it's guaranteed, well, 80% of the rate of return is not guaranteed. It's set every year by the board of directors. And the question then becomes, and the proposition to your clients when you're talking about that is, do you want to place your financial future in the hands of a board of director whose job it is to make sure the carrier is solvent? Or do you think that you're better served in the market, at market kinds of, and you being able to control where your money goes in the market? That becomes the discussion. And that is that's one of the major differences when you talk about whole life versus IUL. Now, there is the argument of, yes, but the death benefit is guaranteed. Well, one of the features in whole life is that it becomes rather inflexible in terms of premium payments and distributions. That you really don't have the ability to skip premiums, to lower your premiums, to increase your premiums. It really is pretty static, very little flexibility. How many of us have really taken a look at what happens, because life happens for people? People have medical bills, people have children cost us money. Children do cost us money. Water heaters need to be replaced. Cars need to happen. Medical bills happen. People have expenses, and it seems like life insurance, their premiums tend to be the first thing that people will skip or cancel. So what happens if you can't pay your premium in a whole life contract? Well, you say, well, they'll use cash value and dividends, all those dividends that build up in order to pay the premiums. That's a change, a material change you have to make to the contract. And if you do that and use dividends and paid up additions to cover premium, then you're not going to have the cash value that was illustrated. Then your cash values have a very negative impact. But if you just skip the premium and don't pay it, what happens internally by definition in almost every whole life contract in the industry? There are a couple of exceptions. And that is that you lose the guarantee of the death benefit. Your death benefit no longer is guaranteed. And that becomes one of the fallacies in whole life. But if you skip a premium payment in IUL, it doesn't have a material effect on the viability of the contract. It will also change your cash values, no question. But you don't necessarily lose a death benefit because you do that. Your death benefit still remains whatever it is. So the guarantee element of whole life is not quite as guaranteed as those that drink the Kool-Aid of whole life want you to believe it is, but it's there. It's not quite as guaranteed. There's much more of a level playing field between the whole life element and an IUL element as well. Then you get into a third category, and the third category becomes the expenses. Whole life is a packaged product. In other words, I have never seen in my experience where a whole life company breaks down the expenses of the policy. How much is it really costing you to get the values that you get? By the way, I'm a believer in whole life in certain situations. I don't think it's the end all be all for everything, but I think there are scenarios where whole life is the way to go. And so it's not that I'm down, I'm trying to badmouth whole life. I am not in any way, shape, or form. But let's use it where it makes sense. So you talk about these expenses where the policyholder or the advisor does not really know where the expenses are or how much that product is actually costing the client versus what's invested. Whereas in the IUL, and those of you that have heard my full presentations to our product, understand that we put great value in being transparent to a design that conserves expenses and controls expenses so that the client is getting the most efficient income possible. Now, how does that translate to that be your own banker concept? At a nexus, we are not as supportive, if you will, of the concept of the infinite banking or the be your own banker concept as some others are. And there's a couple reasons why. And it's not because the products won't do it. It's because of the pitfalls that are out there that most people don't talk about. And that is, if you put in premium today and you withdraw the premium figuratively tomorrow, next year, you really have, or later in the same year, you haven't given it the value of the tax. You really don't get tax deferral, because remember that in IUL, you only get interest at the end of the segment. If the dollars aren't there at the end of the segment, you're not getting the value of the tax deferral or the growth because the money was removed. The other thing that you have is every dollar of premium has an expense associated to it. There's a cost on every dollar. It might be pennies, but nevertheless, it's there. Why would you pay expenses on something you're not getting the value of tax deferral or tax growth? It doesn't make sense. So if you're going to put $10,000 into a contract, to turn around within the same 12-month period to remove 5,000 of it, why put that 5,000 in the policy in the first place? How about just build the policy for efficiency of 5,000, keep the 5,000 in your pocket? Now, if the infinite banking or be your own banker concept is something we're talking about removing money down the road, multiple years, 5, 7, 10 years, now that becomes an entirely different discussion. Now you have viability because you have time to offset the expenses in the contract with the tax deferral and the tax-free growth. Now that becomes a hugely effective scenario. The other area that you run into that problem is in the design. As opposed to designing in those scenarios for a death benefit, again, we want to be designing for efficiency of the cash. How can we put the most cash in and have the lowest amount of expenses so that we see true market growth and you get the value of the tax deferral? So that becomes kind of that infinite banking. Now, the last area when you talk about be your own banker is what happens, and we know it will happen. There's no guarantee to rates of return, just like there's no guarantee to dividends. It's only that 1 year that you have that guarantee. It's set at the beginning of the year. You get the dividend for that year, but next year could be very different. Same thing in market rates of return with indexes. We can't guarantee a specific rate of return. We know that over time we've averaged better or we've averaged a particular rate of return, but that's not a guarantee. There will be years of zero. What happens if you remove that money and you have a 0 year? Now you run the risk of lapsing that contract, which then could create potentially a taxable event. That's where the risk comes into play. And very often in the be your own banker concept, nobody is looking at rate of return risk. You might have a 0 year or theoretically in a lot of contracts, a negative year. And let's talk about that 0 floor because that becomes important. But you could potentially have a negative year so in that you're removing money out and you're running the contract very thin from the get-go. And then you have a negative year and that can create tremendous upheaval. And that's where you have problems with persistency, you have problems with lapsing, you have problems with underperformance of a contract. And those are all of the topics around that we at Annexus are not very comfortable with because we understand that the markets are the markets and it does happen. And so not running the contracts that thin, actually working with overfunding in the contracts, not running them at minimum becomes mission critical, but leaving those dollars inside the contract to make that happen. So let's talk about a little bit of that 0 floor, because I think that 0 floor can become critical, particularly in the be your own banker concept. Many products, and this ties in the expense factor along with the rates of return. You might have a market, let's say, that does 2 or 3%. But when you look at the options within an IUL, you have scenarios where many indices have spreads, asset-based charges, and strategy fees. When a carrier produces rates of return, they don't produce rates of return. They don't publish net of those fees. They publish the rate of return of the index. Now, they may publish it with par rate attached to it. Sometimes yes, sometimes no. But they don't produce it net of fees. And so you have to look at what is the fee structure. You have to understand the design of the product to understand, are the indexes or the options that you're utilizing, do they have asset-based charges? Do they have strategy fees? Because let's say that the index does 3, but you have 5% in a strategy fee or an asset charge. You're actually at -2. Now, you say, well, wait a minute, 0 is the floor. No, 0 is the floor on the rate of return of the index. It's not the floor for net of fees. And that's where the disconnect comes into play. You have to understand what the structure within that contract is to understand the value of a true 0 floor. So when you have 0, no strategy fees, no asset-based charges, and no spreads, you truly have the capability of having a true 0 floor. And that's a separator in the industry, particularly if you're operating in that infinite banking or be your own banking concept. Because in the wrong years, you're actually going backwards in your policy, which obviously can become a major, major factor. So let me pause there. I have a feeling there are a number of questions. Kim, you're scratching your chin. I know you have questions on this. So let me pause there and let me take some questions on this topic.
Yeah, thank you. So will you stop sharing your
Yep.
dividend rate?
Yep.
And then I don't know if you know this, we see your image, but we don't actually see your actual face. Do you know that?
Yeah, I did know that.
Oh, I was like, I don't want to see your face. I want to see your lips moving. But anyway, yeah, thank you. So I think that there's this whole conversation, and obviously, I asked for this meeting. I think you guys probably hear a lot of this as well. I think there's a lot of it on TikTok out there of
Yep.
be your own bank, infinity banking, and then whole life versus IUL and how they handle those things. And obviously that's why I wanted to have this conversation today, is just to understand really truthfully the difference and of whole life and IUL and how that works, right? And what that looks like. I think first and foremost, what I would like everyone to know about the be your own bank and infinity banking concept, it makes sense, right? That's what we do when we use it for the retirement income stream down the road. But if people are really looking at putting money in today and pulling it out, even in 3 years, right? It doesn't matter, 5 years, 7 years, they have to have enough money to put in to actually be a bank. You can't be a bank without money, right?
Right.
So unless we're talking about significant deposits, for most people that isn't going to work. I know Debbie and I have this conversation quite often because she's a part of a big real estate group, and everybody wants to put money in and pull it out tax-free and use it to buy real estate, which is great. But then I'm like, well, how much can you afford to set aside? $200 a month. Well, you need to go make a bank with $200 a month. So I just want you guys to be able to articulate those things to people, right? Like I want real life, common sense conversations. Is it a fancy concept? Yes. Could it work in certain situations? Yes. Do most people have the amount of money necessary to actually make a concept like that work? No. But on TikTok and all these other places, right, it's sexy money. And that's what people want to talk about, right? Is that sexy concept and what's going to have people follow me? What's going to have people go, oh, wow, I didn't realize it worked that way. And so I just want you guys to be armed with the tools of the conversation. So when people say, that's great, I love this concept of IUL. Now that you've educated me, I've actually decided, I have a lady currently right now that's decided that she wants whole life instead of an IUL. My meeting is tomorrow, so I can't tell you why she thinks that, other than whatever research she's figured out there. So you will run into this. You will run into these conversations. And I just wanted you to be armed with some of the some of the bullet points, I think, behind it. I think one of the biggest ones that you said, Al, to me is that whole life is inflexible, right? That's one of the beauties behind the IUL. Remember, Zach and I have been in this industry, as have several of you, for 22 years. I've written lots of IULs, VULs, policies like that use this concept over time. And 6 months or 2 years in, they lose a job or something changes or it just isn't the way life was expected to be. And they call and they're like, hey, I need to reduce my contributions. Well, in an IUL, they can. Right? They have that moment. As long as there's cash value to cover it, they've got that moment to cover that, and then they can always pick it back up. But I think, you obviously explaining the fact that you lose the guarantee on your death benefit, that's huge. I didn't realize that. I didn't understand that. I just assumed the cash value would pay it until it was no more. But anyway, so just different concepts and things like that I think you should be aware of. Jody, did you have something you want to say? I know you were unmuted.
No. I mean, I just actually was going to make that point, as far as the bullet points, it's just like you were saying, and it comes down to controlling narratives.
Yes.
It comes down to whenever, we're talking to people, we have to be the one getting where they're getting the information from, because, if somebody's out looking, they may see somebody they like, or somebody said something a certain way or whatever, and that's why we got to control that. It's good to know for us to be strong on these things. And if people are going to research, we want to control that narrative. But I do know that the key is not so much the negatives of other things as it is the positives of what this
That's
concept is. There's some great books, simple books, whether it's McKnight's piece or, Zero's, the Heroes thing, or whether it's that real simple little book that we show. I can't remember the name of it right now, but the other one being,
Power Zero.
The Power Zero. Is that, no, I'm not talking about the Power Zero. I'm talking about the little one about life insurance, about how Walt Disney and those guys used it. I can't think of it right now. I'll think of it in a second. So the other one was, of course, the one that we used the most is Tax-Free Retirement, Patrick Kelly, which does a great job. But if you got somebody who's in that world, we got to control that. So anyway.
Hey, Jody, are you talking about Money, Wealth, and Life Insurance?
Yes, that book. Thank you. And it's a real simple little book, and and I think it's a real easy read for most people. So that one's a real good one. But you don't want to bombard somebody, but once they get in, if they are starting to get off into the weeds on this, they need to understand it. But the biggest issue is going to be
Control the narrative.
You have to control the narrative, and also the fact that there is no flexibility within the product, and also over time, you probably are going to be able to have a better return inside of an IUL, because it does have the upside, that is just very strong. So
I have a
anything,
question. When you say that 80% of the return in a whole life policy is just a return of excess premiums, to me that says they're just giving me my money back that I've already paid. Is that accurate? Like, am I misunderstanding, or is that the truth?
No, you're really not misunderstanding. By definition, theory, the textbook says that the definition of a dividend is a return of excess premium. That's by definition accurate. The remaining 20% is actual interest earned from the general account to the carrier.
Mm-hmm.
That's what whole life is. It's a general account return kind of product. So you are guaranteed return from the general account, which typically 3, 4, 5%, something between 3 and 5% as a general rule. That's the rate of return that you're going to get. Now you wouldn't, as a general rule, you wouldn't buy an IUL if all I was able to show you was a 3% return. Why would you take the risk of the market to earn 3%? You wouldn't. Then you'd go to a whole life policy and say, hey, I can get that guaranteed plus get my dividend. That's great. Perfect. That's exactly the place. In my career, I used whole life exclusively when you're talking about survivorship. If I was doing a joint policy or I was doing estate planning, I didn't want the flexibility in there. I didn't want the unknown of return. I wanted guarantees all day long because it's an estate plan. I only used whole life. But if it was an individual planning situation like Kim described, where you're looking at having the ability to take dollars out to utilize for different kinds of life events, then I needed return. But you're 100% right that like I say, 80% of the overall return is dividend generated according to the industry. Those are LIMRA statistics. Those aren't a
So if I
carrier
see an
statistic.
8% return, 80% of that 8% is just my money.
Yep.
Only
Yep.
20% of that 8% is actually a return.
Yep. Now that's a broad industry
I
statistic.
understand, but conceptually and
Conceptually, that's it.
I mean,
Yeah.
you have this conversation with your clients and you pull up the definition and you explain it, like, how do you argue with that? Right?
Yep.
Like that's what it says.
Yep.
And I hear what you're saying about whole life, and I know the guarantees, you know, assuming that you pay your premium and you don't have a lapse or anything like that, right? So you don't lose the guarantee. I know that that matters, but there are some IULs that have guaranteed death benefits
Yes.
as well.
Yes. That is an innovation in today's world, that you could put a rider on that guarantees the death benefit. Now, remember that death benefit and riders have expense associated to them.
Mhm.
So the more of that you have, meaning the more death benefits you buy, the more riders you add,
They're more expensive.
the less cash you're going to have, because it's going to be a drain on the cash. That's not to say it's no good. I
Right.
am not suggesting. I'm simply saying you have to understand that you can't have peak guarantees and peak cash. There's a crossover point. There's a point where it makes sense, and there's a
Yeah.
point that it doesn't. So this is where, to Jody's point of controlling the narrative, what is it you want this solution to solve? What is the desired solve of your personal planning scenario? Is it those guarantees? Then it makes perfect sense. Or is it, I need to maximize income? Well, then you have to not necessarily minimize death benefit in riders, but you have to control them.
Right.
And that's where you do advanced design. This is where the whole idea of advanced design and kind of the Annexus methodology is, that we want to do that on virtually every case. That, and again, there are the right time to use riders and high death benefits, and there's the less advantageous times. Both are accurate, both are good, but that's exactly right, Kim. You are exactly
Okay.
right.
Well, I think that piece of it is fascinating, and it's something that I always, it just confused me because it doesn't make sense. Why do I give you money for you to give it back to me? Like, it doesn't make sense.
Yeah.
Let's open it up, Jody, if you're okay with that. I see you turned your camera off, so I think you are. Does anybody have any questions? Like I get this a lot, so I assume you guys do too. So while we're here and while we've got Al with us, anybody have any questions that he can answer for you?
I want to just what everything that Al just said, I think it makes perfect sense. I think that knowing that 80% of the dividends that are returned to us is just an overage of cash funded in that policy, 20% comes from the market, that the actual rate of return from the market. And if that's 3 to 5%, overall, you're not even, it doesn't seem to me like you're even getting near 3 to 5% rate of return if it's only 20% of what you're getting on the dividend. Do you understand what I'm saying?
Yeah, although it wouldn't be the way they would describe it to you, because they would call dividends a rate of return, but by definition, it's return of premium. So
Right.
when they show you rate of return, they show you the dividend rate plus the guarantee rate, and it may be 8% overall, but yeah, you got to calculate. This is why they don't typically, most whole life contracts will never show you a breakdown of expenses or interest earned, for exactly this reason. And it's what we call a packaged product. This is why they don't do it. Because if you really saw how it broke down by category and by factor, you might not think the same way about it.
You're muted, James.
Oh no, I'm just talking out loud. Yeah, it makes perfect
Oh.
sense. I mean, you're gonna consider other options, obviously, if you were to see that, because you see no real value that's transferred to the client.
Yeah.
Other than the guarantees. So
Any other questions out there? I mean, you guys know I'm kind of a dork on this stuff, so I'm like, what'd you say? Let me hear that again. Because I want to know. I want to be able to articulate it and explain to people, because I think there are a lot of, especially, I know I keep saying TikTok because obviously that's on my brain, but there are a lot of 30-second clips out there, right? And a lot of them have great pieces of information, but not all of the information. So I like to know how things work, and then I can make my own decisions. But anybody else have any questions or any burning desire to understand something that you might not understand while we're here?
I've got a real quick question. This is being recorded, so we will be able to send this, right,
It's on
to
YouTube.
our team members? Perfect. Okay, thank
Yeah,
you.
it's on our team recordings. Yep. Any other questions from anybody else while we're here?
I'm
All
really
right.
glad.
Well,
I'm really glad Greg Smith is not speaking up, because I don't want his questions.
How we doing, Big Sexy?
I can't understand you. Did you say something?
he had to
The
ask
lo-
his questions of Tim earlier. Mhm.
Oh, good, good. You save them all for Tim. That's great.
Yeah. Maria, you have a question. Go ahead and unmute yourself.
Hi, Ellen. This is Maria. And
Hi, Maria. Yeah, how are you? Good.
Good, good. For me, it was very interesting. Then you say then the zero. It is not exactly the zero what we are often in the floor, and
Right.
it opened up my mind because truly, even then that year. We get the zero, but we do have the expenses.
Yes.
So I never realized that. And you know what? This is a very good point for me to embrace my client and just to let them understand you have to max fund it, your account in order for you to see the value of what we are offering you right now. So if you can elaborate this a little bit more and giving more advice, I truly appreciate it.
Sure. Well, the idea of max funding, I don't know if I would quite go to that level of declaration, but I would surely say, particularly in a Nexus products, I would not design cases lower than target premium. You always should be paying target premium or more. Whether it actually gets to max funding, that's a different question.
I think that's true with everybody. I know you've got to kind of walk the tightrope by just speaking for you guys, but you're right. In general, no one should write a policy that's
Yeah.
not at least above target premium.
Yeah, if you're exactly
In
if you're
between,
gonna
in between, really about halfway between target premium and max funding is a good place to be, and they can
Yes.
always put in more money.
Yeah. If the client needs to fund it below what target would be, then you might be really dealing with a term sale, because then it's a budgetary issue, not necessarily a cash accumulation.
Chargeback waiting to happen.
I'm sorry?
It's a chargeback waiting to happen.
Oh, yeah, 100%. 100%. Yeah, so I would agree with the statement there. The closer you can get to max funding, the better you're going to be, but at least target. And there's where you have a sliding scale. And you're right, it doesn't matter whose product it is. You have a sliding scale there. There is room. And the value in an IUL, all IULs, is that you have that room, that this year it might be a $5,000 premium, and next year it could be a $7,000 premium, the following year 10, and then you can go back to 5. You have that capability in IUL. The big thing that affects that is what your cash values will be. But at least they know that the more they fund, the bigger that cash value gets theoretically. The less they fund, the lower it's going to be. So yes, that is one of the virtues, the positive virtues of utilizing IUL versus other kinds of products. So Maria, I would say that's exactly correct that way.
Hey, by the way, guys, we're going to do part 2 of this next week. And, I really want to introduce this other concept to you, and, because I love if you watch Rory, you'll know that about half of all his presentations are on be your own bank, just because he knows that he uses that phrase, gets them in. And he uses that all over just to get them in and talk to them about a general policy. But I want you to use this phrase, say, well, are you interested in the infinity banking concept on steroids? What if we could show you a way to do that and supercharge it? Use that phrase, and I guarantee you that'll get people interested in what you're talking about. And then come back to the table, take what you learned today, and some more things we're going to show you next week. Absolutely blow your mind. So, James, I think you had one more question.
Yeah, it was just a quick question for Al. Al, I appreciate all the info, man, and just the knowledge bombs that you're dropping today. I'm curious to know from your experience with the Nexus and with Nationwide specifically, is there a minimum threshold of premium to be paid in on an IUL that would make sense? Like, I'm just kind of curious because obviously the more money we put in, the more flexibility we have in terms of structuring that policy and accumulating cash. But for a lot of people out there, I know things are getting tough, but is there a minimum threshold, a minimum amount that would be needed to properly fund an IUL, and what amount or when would be the cutoff versus when would it not make sense to put that money in an IUL?
Yeah, remember that premium is a direct reflection of death benefit and the amount of years that you want to be paying for. So there isn't a minimum in terms of premium. The minimum is in terms of the death benefit size. So our minimum contract is $100,000. But what would $100,000 cost for you at your age versus, and I'm going to make this up, versus a 6-year-old? That's going to be very different. Or a 60-year-old versus a 30-year-old versus a 6-year-old. Those premiums are different. And max funding, 100,000, I'm just using 100,000, the minimum death benefit. Max funding is a different number. So while max funding for a 6-year-old might be $1,000 a year, for a 30-year-old, it's going to be $10,000 a year. And for the 60-year-old, it might be $30,000. So that number changes based on their age and their time period, and then the death benefit. But we don't do policies under 100,000. So that becomes your benchmark. And so very often in our design, and this is where our design becomes very different, is we solve exactly the way, James, you're talking about. When we run illustrations, we don't run it for X amount of death benefit. We want to know how much can you afford to contribute to this plan, and then we'll solve it backwards to calculate a death benefit to keep it within IRS regulations of a non-MEC and defined as a life insurance policy. That way we're conserving the efficiency factor. That's exactly, and Kim, to your point on the infinite, or Jody, on the infinite banking concept, you're really driving infinite banking to be able to take cash out. That's really the driver to that whole concept, is the ability to get cash out of it. So if you want to get cash out of it, you have to put a lid on expenses. And when you talk about life insurance, expenses is death benefit, expenses is riders. So you got to put a lid on that. You got to control that to the nth degree and create ultra efficiency in the concept. And that's where that whole concept becomes viable.
Yeah, I agree. And some of you guys, I'm sure this is Greek to you, right? Like you're like, what are you talking about? Like you can't even wrap your head around it. And that's okay, right? Know that these calls are not designed for you to be the expert today, but the more of them that you hear, and the more of the conversations that you hear just in the world around you and from your field training, things like that, you'll pick up pieces and nuggets. I don't understand everything Al said, but I understand that what dividends are now, right? And that's really important, and how that works, and at least how to articulate that. So anyway, it's a big deal. So just know that. Jody, you want to wrap it up for us?
Great job. You're always, thanks, Kimberly, for always leading the charge on the conversations, and great stuff, guys. We'll keep this narrative going. Next week, it's all about education. But listen, none of it matters if you don't go work, if you don't open your mouth. We give you this information so that you can turn around and act on it. That's our expectation. Go tell the story. Don't be a tour director. Don't be just going out and answering all the questions, be getting people to decisions, finding out, hey, what do you have? What do you need? And let's get going. Thanks, guys. See you next week.
Thanks, Al.
Thank you.
Thank you.
Bye, guys.